Thanks a lot for joining us today. So today we're going to talk about property funds and we're going to look at the impact on investors of recent market movements, but also fund suspensions. I'm Laura Suter, Personal Finance Analyst at AJ Bell, and I'll be talking you through all of this today. So if we dive right in, if we look at the impact of the coronavirus on property, what we've seen is kind of a perfect storm for property funds. Outflows from property funds, so investors redeeming their money, had ramped up a lot in 2019. There was a lot of Brexit uncertainty, there were worries about the death of the high street, and then there were also worries about specifically the Brexit impact on office office demand, particularly in London and other big cities. Then on top of that, what we saw this year was worries about the impact of COVID-19 on valuations of property funds. What we saw was some uncertainty around how to value property assets during the big market movements that we saw in February and March of this year. So those two factors together meant that property funds suspended. And we'll cover all of these aspects in a bit more detail as we go throughout the presentation. But firstly, if we look at outflows, so this was really what started off the original problems and issues that property funds had. So what you can see here is a large spike in outflows around the Brexit referendum date. So that is going back all the way to 2016 now, even though it doesn't feel like that far away. So about 4 years ago, we saw big outflows from property markets, and this was really caused by the referendum result, meaning that people were concerned about the impact that that would have on property prices in the UK, the impact that it would have on high streets, but also on demand for office space particularly. So that caused a lot of investors to redeem their money from property funds. So in June 2016 alone, there was £1.5 billion worth of money pulled from property funds, which is based on Investment Association data. And if we look at that kind of 3-month period, so May to July, that we can see on the graph there, in that period alone, there was 2.3 billion of outflows from property funds. And so, as we all remember back at that time, that meant that property funds didn't have enough cash on hand to meet the outflows, and they couldn't sell property quick enough. As anyone who's tried to sell property knows, it's not something that you can do overnight. And so they had to suspend funds then because they just simply didn't have enough cash to meet the withdrawals that that investors were requesting. And then as we go through, we see kind of a mixed picture over the next few years. We see some occasional spikes. So for example, that spike in August 2017, where £500 million was pulled from property funds. That was around the time when the UK released some papers around Brexit and the impact of it, but also there were kind of ongoing wranglings between the EU and the UK over what the nature of Brexit would look like. And then as we continue through, we have some months of inflows where people return to the funds. And then we hit this really chunky period of outflows. So where we stand today, based on this Investment Association data, we've seen 20 consecutive months of outflows from property funds. And in 2019, every single month saw outflows from property funds. And so what we saw was really an increase in outflows as a result of Brexit uncertainty, and it was more that investors just weren't sure what the impact on the property market would be. But it wasn't just that, it was also around this time we had a lot of talk of the death of the high street. We saw some quite big retailers either fold or announce that they were in trouble, and obviously these retailers are big tenants for property funds, and that would have had an impact on the price and the valuation of properties, but also around investor nervousness. So in 2019 in total, there was £1.9 billion worth of money taken from the funds over the year. And then we saw this spike in December where the M&G property fund closed, which we'll cover in a bit more detail. And that was the first one to suspend. And that led to a spike in outflows from investors pulling money from other property funds amid worries that we were going to see a similar situation to what we'd seen in 2016, which was where one closed and then that caused a bit of kind of panic selling among other investors. So in December last year, we saw 263 million of outflows from property funds. So that explains that large spike kind of as a reaction to the M&G fund closing. So if we look at the M&G fund in a bit more detail, so this is the M&G property portfolio. It was the first one to suspend this time around in December, and actually quite far ahead of the other ones, which we'll cover later. It remains closed today, and it was the second suspension for the fund in less than 4 years, because it had also had to suspend in 2016 around that Brexit referendum. This suspension was a bit different to some of the others in the market that we've seen this year. So M&G's was a case of those outflows that we talked about impacting the fund and it running out of cash. So it was really a replication of what happened in 2016, where it had too many people wanting to redeem their money and it didn't have enough cash to meet those outflows, and so it suspended the fund in a bid to sell some of the property, realise some cash and be able to reopen the fund and pay out investors. So around the end of October, which was the latest data we had available when it suspended in December, it only had about 5% of the fund in cash. So this was presumably where cash levels had been higher, but had been depleted by people already redeeming their money. And it had been trying to sell off more assets in order to meet those redemption requests, but hadn't managed to do so in time. And if you think about how long it takes just to sell one house or one flat, and then you think about trying to sell a multi-million-pound office block or retail park or shops, for example, or large student accommodation blocks, then you can really get an idea of how long it really takes to sell off this property. One interesting thing that did happen this time around was that M&G decided to waive some of its fee on the fund. So it waived about 30% of the charges on the fund. This isn't something that we saw at all when property funds suspended in 2016. But if we frame the M&G fund closure, it came not long after the Neil Woodford fund closure, and there'd been a lot of criticism at the time of Woodford Investment Management continuing to collect their fee and not waive any fee. So it's likely that the M&G concession on the fee was a reaction to that. It's not clear how they got to that 30% discount figure. It feels slightly plucked from the air, and no explanation was given on why the fund being suspended would lead to a 30% drop in costs, but it was kind of a concession for investors, I guess, so it didn't face a lot of the criticism that Neil Woodford had done so. So then after we saw that, we saw the rest of the property funds close. So the situation that we were in was the majority of the open-ended property fund sector closed, where they were invested in UK direct property. So you had the likes of Standard Life, Prudential, Aviva, St James's Place, lots of big funds, and what we ended up with was around £13 billion worth of investor money in property funds suspended. But there's a big time lag between that M&G fund closing and the rest of these funds closing, and they actually closed for a different reason. So they closed in March, and it was as a reaction to there being uncertainty about what their assets were actually worth. So these property funds have independent valuers, and they determine what the assets of the fund are worth. This provides a kind of check and balance on fund managers, and an independent view of how much the assets are worth. There's a handful of these independent valuers in the market, some of the big names in estate agents and in property, so Knight Frank, for example, is one of them. But these valuers determined that because of the wild market movements that we were seeing at the time in February and March, it was impossible for them to accurately value what property was worth, because so much was uncertain at that point, and still remains so, around the impact of the COVID-19 crisis on property assets, on valuations, they deemed that they couldn't get accurate valuations for the funds, and so these funds suspended. Now, they might previously not have had to have suspended, but some FCA work that was done after the 2016 property fund suspensions meant that there were new rules that came in. So these FCA rules state that a fund has to suspend when a valuer has uncertainty about the price of 20% or more of the fund's assets. So put more simply, if a valuer can't determine the value, the true value or accurate value of 20% of the fund's assets or more, then the fund should suspend. With property funds, clearly, if you can't get an accurate valuation for property across all different sectors, that makes up almost 100% of property funds. So they had no choice but to suspend. And on suspensions, they're not necessarily a bad thing. They help to protect investors. They help to stop that first mover advantage, where those investors that are quick to rush for the exit get the advantage of better pricing and better liquidity versus those that are slower to move or haven't spotted the news quite as much. It also means that funds don't use what are called fair value adjustments or market value adjustments, which is something that we saw in the lead up to the suspensions in 2016. But obviously it does open up the gap between open-ended property funds and closed-ended funds. As closed-ended funds obviously won't suspend, investors will still be able to get their money out, but they may well have to do so at a big discount at that point in time. So if we look back across the timeline of how these fund closures happened, we had the M&G fund closing in December, and then that sparked outflows, as we've talked about. And M&G fund remains closed. It actually came out with an update recently and said that it would remain closed for another 28 days and gave an update on the state of the portfolio. And that most recent update gives a real insight into the challenges that all of these funds are facing. So M&G says that gradually some areas of the market are becoming easier to value, or you're being able to accurately value them. So their independent valuer has now said that central London offices, student accommodation, industrial and logistics property can now all be accurately valued. So it can come up with an accurate price for those. That, unfortunately, for M&G, for investors in the M&G fund, only accounts for just less than 30% of the fund assets. So 30% of the fund is in those different sectors. That means 70% isn't, and is in other sectors that the independent valuers still say that they can't get accurate pricing on. The M&G update also showed that it has around £180 million worth of property that's either under exchange or under offer, but is very keen to point out that in the current climate there are no guarantees that those sales will go through, or that those sales will go through at the price that's been agreed. So in the 6 months or so that the fund has been suspended, it's sold around 150 million of assets, and it's still got 180 million of assets that it wants to sell in order to realise enough cash as well to be able to reopen. So you can see the kind of balancing act that it's facing here. And then as we go through the timeline, we've covered some of this already. So the Keynes Property Income Fund was the next one to suspend in March, and then the majority of the property sector suspended. Those funds, bar one, all remain closed. But in June, in the middle of June, the BMO Property Growth and Income Fund was the first to reopen. So that fund is what's called a hybrid fund. So it invests some of its assets in physical property, buildings and shops and retail parks, but it invests 70% of its money in property securities. So that means that once there was clarity about some areas of the market that returned, so like we saw with the M&G one, where central London offices and student accommodation, for example, there's been clarity around pricing on those. Once we saw clarity around some areas of pricing, because physical property only accounts for around 30% of that BMO fund's assets, it would quite quickly fall below the 20% limit that the FCA set. And so it would no longer have uncertainty about 20% or more of its assets valuations, and then that means that it could reopen. And so this fund reopening, and being the only one to reopen so far, sparks some questions around whether we might see more of these hybrid funds. Previously, people, investors and advisors alike, hadn't necessarily liked them, or the critics of them had said that they didn't truly reflect a property investment. So rather than owning a physical building and your returns on the fund being purely determined by the value of those underlying assets, it invests in property companies, which then means that it's subject to the rises and falls of stock markets as well. And so some argued that that hybrid fund didn't work for them. It didn't give them the pure property exposure that they wanted. But with the issues around liquidity that we've had, it might well be that we see a bit more of that coming through. It's probably unlikely that too many people are going to launch new property funds for a while to come, because the sector has been so out of favour. So it's probably likely that we wouldn't necessarily see new versions of funds launch with that hybrid nature, but it might be that some existing funds, as a way to meet those liquidity issues, switch to this hybrid nature, but we've not seen any examples of that so far. And then around that same time, it was announced that the fund manager of the M&G property portfolio, so that first one to close, was leaving, was stopping running the fund. So after 27 years working on the fund, she was stepping down as the manager. And interestingly, the new fund manager, Justin Upton, said that he wants to focus on getting income while also maintaining liquidity within the fund, which is obviously a very tough balancing act, because the more cash you hold in the fund to meet that liquidity requirement, the lower your returns are on the fund generally, and also the lower your income is. And then finally, most recently, we've had the FCA talking about the fact that it wants to look again at the issue of liquidity in property funds, and we'll come on to a bit more of that later. So this just really summarises the funds, the biggest funds that closed. So anything greyed out is a fund that remains closed, and it just shows the fund sizes of them, but also the returns that we've seen on property over the past few years. So over the past 6 months, returns have been fairly meagre. So the average return has been a loss of 5%, but there's quite big dispersion in that. So the worst performing fund has delivered a 13% loss. And even over a 5-year period, investors haven't really seen great returns. So the average for the funds is only a 9% return over that 5 years, and that's a total return over that period, that's not annualized. But again, there's been very big dispersion in returns over that time, running from a 6% loss on one fund to a 24% gain on another fund. So this really frames the backdrop that property returns, particularly from certain funds, have not been great for a while. But income is one of the main reasons why investors move into property. It's obviously a very good way of diversifying your assets away from equity markets and from bonds, for example, and gold. But income is one of the big drivers for investors. So you're seeking to make a bit of return on the property investments themselves, but also you want a steady income. And commercial property tends to be very good for that, because contracts are drawn over very long periods of time. You lock tenants in for a very long time. There's often very regular rent reviews or built-in inflationary increases in rent. So previously, it's been a very reliable source of income for investors. However, the current crisis means that there's been lots of calls for rent cuts from various different tenants, and a lot of landlords have felt pushed into a corner in terms of having to cut rent to enable businesses to stay alive. So as a landlord, you're a little bit stuck because you don't want to refuse all requests for rent deferrals or rent cuts, because that could be the thing that tips your tenant over into going bankrupt, and then you have no tenant. And in the current climate, re-letting that property, you're unlikely to get the same price that you'd already signed up for it. You're unlikely to get the same rent, and you might really struggle to rent it in the current market because there's not lots of demand in some sectors. It really depends what areas we're talking about here. So obviously a lot of the examples here are from retailers, so property funds that own a lot of high street stores or retail outlets or out of town retail parks, things like that, will be harder hit than some that have diversified more or moved away from this sector. But what we've seen in the past couple of months is lots of companies of all sizes asking for either rent cuts or deferrals, so delaying paying. So for example, Topshop owner Arcadia asked for a 50% cut to their rent. Others have asked to go from quarterly rental payments to monthly in a bid to help control their cash flow. Others have asked for service charge reductions. So these are the fees that landlords tend to charge for maintenance costs or energy, and they've asked for reductions in that. The difficulty for landlords as well is that all of these discussions are individual with each tenant. Now you might have one company that's a tenant across multiple of your properties, but there's no set way that landlords have to deal with this. And to a certain extent, as we can see from one of the examples here, one of the headlines here, this has been an issue for a while in terms of in the retail landscape, as retailers have struggled to compete with online. A lot of that has led to them pushing back on landlords and asking for rent reductions. But it's even more so something that we saw during lockdown, when lots of businesses just simply weren't open and didn't have any cash flow in order to pay that rent. So if we go back to the example of the M&G Property Fund, it said that in March it received around 2/3 of the rent it was due. Now that's actually better than some landlords have seen, and it said this has now risen to 71% of the rent that it was due. So it's a slight increase over the summer as more businesses have opened, and you'd expect to see that increase further as lockdown measures have been eased and more companies can remain open. Obviously, the worries about a second wave or a second lockdown mean that if that happens, then we could see a return to what we saw in March, which was lots of companies asking for rent reductions or deferrals. But if we look at those M&G figures, so it's saying that it's collecting around 70% of its rent now, and it says that investors should view that and see that as an indication of how much their income is likely to be cut. So if your fund manager is taking in only 70% of the income that they were before, then you can expect that your payout is going to be around 70% of what it was previously. So property investors need to be braced for a trimming of their income, and income investors have been hit particularly hard during the current crisis. We've seen a lot of companies delaying or deferring or cutting their dividends, which has hit income investors. And I think because of the nature of property funds, some investors don't necessarily know that the income is going to be cut yet, or these property funds have not announced that what their future dividends and payouts are likely to be. So it's something that investors need to be mindful of and need to be asking fund managers about what the expected cut in income is going to be so that they can prepare for it. So if we look back at those closures in 2016, we can see how different the situation is today. So not only, as I talked about before, were those closures due to outflows and lack of cash and liquidity available at the funds, they also occurred for a much shorter period. So the only issue for funds then was that they needed to sell off property to realise more cash, to be able to reopen and meet redemptions from investors. During that market, it was obviously, we saw market falls, but not like we've seen this year in terms of the prolonged impact of them and the likely long economic impact of them. And so it was still, in comparison to today, it was still relatively easy to offload those properties. And that's reflected in the number of days that the funds were suspended. So in the example of the Aberdeen fund, it was only suspended for a week. The M&G property portfolio stayed closed for the longest, but was around 4 months. When you compare that to today, it's now been closed for more than 7 months. So it really highlights that while the issues of liquidity are recurring again, and the issues of suspensions with property funds are recurring again, we're in a very different scenario now. So while we can learn some lessons from last time, it's not easy to draw direct parallels in terms of how long these funds were likely to be closed for. And then most recently, we've had some commentary from the FCA on their views on property funds. So Chris Woolard, who's the interim chief executive of the FCA, that came out recently this month and talked about how the property sector had reacted and the impact on investors. So there's been a lot of talk about illiquid assets being held in funds that offer daily liquidity. We saw it initially with the property fund closures in 2016. We also saw the very high profile case of Neil Woodford last year, whereby the fund was invested in different illiquid assets, so very small unlisted assets, and that caused an illiquidity mismatch in the fund. The FCA has already done some work on this. So after the 2016 property fund suspensions, the FCA did some work on whether the fund structures were suitable, what changes could be made to help investors, and that's where we got this 20% rule that I talked about earlier. So where funds, and not just property funds, any funds that invest in more liquid assets or even multi-asset funds, where funds have uncertainty about the valuation of 20% or more of the assets, they have to suspend. And so the FCA deemed at the time that fund suspensions were an effective way to manage these liquidity issues, and that they were in the best interests of investors. And so that's why we've seen these closures happening today, and that's in line with what the FCA would expect. However, it has now announced that the regulator will consult later this summer about whether there should be a different way of managing these property funds. So clearly, while the previous rules that they implemented are taking place and have changed how these property funds have reacted to the current crisis, the FCA is obviously not sufficiently happy with how that works for investors, and so wants to look at different options. One of the options that has been talked about previously and that's been put forward by various people, including the Investment Association, is a long-term assets fund. So this is a fund where you wouldn't offer daily liquidity on it. So you might offer, when it was set up, you might offer monthly liquidity or even quarterly liquidity, or in some instances you might decide that annual liquidity is more suited to the fund assets. One of the difficulties here is a resetting of investor expectations. So investors have got so used to being able to buy and sell funds every day. And so educating investors about why this might be a better thing for them, how this would work in practice, the fact that their money would be tied up for longer. A lot of that work would need to be done before these funds could be launched and be successful. There's definitely precedent that's set. So certain saving products, for example, so if we look at cash savings accounts, they operate on a fixed term where you have restricted liquidity, and you can only access them after 3 years, for example, or notice accounts where you have to give a certain number of days notice before you can access their money. So there's with that as the precedent, there's obviously willingness from savers and investors to tie their money up if they think that they're getting something in return. In the example of savings accounts, you're getting a higher return in return for that. So it would have to be made very clear what investors were getting for sacrificing this liquidity. So it'll be interesting to see what the regulator comes up with this time. There's an element where people feel like this is a bit of deja vu because they consulted last time and came up with new rules after the 2016 fund closures. Now funds have suspended again. They want to consult again and look again at it. So we would encourage that process to be quicker than usual. But it is also tied in with the Woodford situation from last year, which had sparked more commentary around this issue of having illiquid assets in a daily liquidity fund. So it will likely encompass some of the issues there, and it's certainly not going to be focused just on property funds. They're just the most recent example of it. So we look forward to seeing what they come up with. And thanks a lot for joining me today. I really appreciate it. And if you have any questions, you can get in touch with the information on the page here. And thanks again.